represents a break-even position on underwriting, and higher figures represent underwriting losses. We are unusually concentrated in auto lines where stock companies had an improvement from 113.5 to 107.4. Our own overall improvement was even more dramatic, from 115.4 to 98.7. Our major insurance sector in insurance, the traditional auto and general liability business of National Indemnity Company, had an outstanding year, achieving profit levels significantly better than the industry generally. Credit for this performance must be given to Phil Leach, aided particularly by Roland Miller in underwriting and Bill Lyons in claims. Volume at National Indemnity Company grew rapidly during 1976 as competitors finally reacted to the inadequacy of past rates. But, as mentioned in last year's annual report, we are concentrated heavily in lines that are particularly susceptible to both economic and social inflation. Thus, present rates, which are adequate for today, will not be adequate tomorrow. Our opinion is that before long, perhaps in 1978, the industry will fall behind on rates as temporary prosperity produces unwise competition. If this happens, we must be prepared to meet the next wave of inadequate pricing by a significant reduction in volume. Reinsurance underwriting has lagged the improvement in direct business. When mistakes are made in the pricing of reinsurance, the effects continue for even longer than when similar mistakes are made in direct underwriting. George Young, an outstanding manager, has worked tirelessly to achieve his goal of profitable underwriting, and has canceled a great many contracts where appropriate rate adjustments were not obtainable. Here, as in the direct business, we have had a concentration in casualty lines which have been particularly hard hit by inflationary conditions. The near-term outlook still is not good for our reinsurance business. Our home state operation continues to make substantial progress under the management of John Ringwalt. The combined ratio improved from 108.4 in 1975 to 102.7 in 1976. There still are some excess costs reflected in the combined ratio which result from the small size of several operations. Cornhusker Casualty Company, oldest and largest of the home state companies, was the winner of the Chairman's Cup in 1976 for achievement of the lowest loss ratio among the home state companies. Cornhusker also achieved the lowest combined ratio in its history at 94.4, marking the fifth time in its 6 full years of existence that a ratio below 100 has been recorded. Premium growth was 78% at the home state companies in 1976, as market position improved significantly. We presently plan a new home state operation later this year. Our home and automobile insurance company subsidiary, writing primarily automobile business in the Cook County area of Illinois, experienced a strong recovery in 1976. This is directly attributable to John Seward who, in his first full year, has revamped significantly both rating methods and marketing. The auto business has been shifted to a 6-month direct bill policy, which permits a faster reaction time to underwriting trends. Our general liability business at home and automobile has been expanded significantly with good results. While it remains to be proven that we can achieve sustained underwriting profitability at home and auto, we are delighted with the progress John Seward has achieved. Overall, we expect a good year in insurance in 1977. Volume as high and present rate levels should allow profitable underwriting. Longer term, however, there are significant negatives in the insurance picture. Auto lines, in particular, seem highly vulnerable to pricing and regulatory problems produced by political and social factors beyond the control of individual companies. Insurance investments pre-tax investment income in 1976 improved to $10,820,000 from $8,918,000 as invested assets built up substantially, both from better levels of profitability and from gains in premium volume. In recent reports we have noted the unrealized depreciation in our bond account, but stated that we considered such market fluctuations of minor importance as our liquidity and general financial strength made it improbable that bonds would have to be sold at times other than those of our choice. The bond market rallied substantially in 1976, giving us moderate net unrealized gains at year-end in the bond portfolios of both our bank and insurance companies. This, too, is of minor importance since our intention is to hold a large portion of our bonds to maturity. The corollary to higher bond prices is that lower earnings are produced by the new funds generated for investment. On balance, we prefer a situation where our bond portfolio has a current market value less than carrying value, but more attractive rates are available on issues purchased with newly generated funds. Last year we stated that we expected 1976 to be a year of realized capital gains and, indeed, gains of $9,962,000 before tax, primarily from stocks, were realized during the year. It presently appears that 1977 also will be a year of net realized capital gains. We now have a substantial unrealized gain in our stock portfolio as compared to a substantial unrealized loss several years ago. Here again we consider such market fluctuations from year to year relatively unimportant. Unrealized appreciation in our equity holdings, which amounted to $45.7 million at year-end, has declined by about $5 million as this is written on March 21. However, we consider the yearly business progress of the companies in which we own stocks to be very important. And here, we have been delighted by the 1976 business performance achieved by most of our portfolio companies. If the business results continue excellent over a period of years, we are certain eventually to achieve good financial results from our stock holdings, regardless of wide year-to-year fluctuations in market values. Our equity holdings with a market value of over $3 million on December 31, 1976 were as follows. No of Shares Company cost $141,987. California Water Service Company $3,608,711. $1,986,953. Government Employees Insurance Company Convertible Preferred $19,416,635. $1,294,308. Government Employees Insurance Company Common Stock $4,115,670. $395,100. Interpublic Group of Companies $4,530,615. $562,900. Kaiser Industries, Inc. $8,270,871. $188,900. Munsingware, Inc. $3,398,404. $83,400. National Presto Industries, Inc. $1,689,896. $170,800. Ogilvy and Mather International $2,762,433. $934,300. The Washington Post Company Class B $10,627,604. 1977 Letter Berkshire Hathaway Inc. To the stockholders of Berkshire Hathaway Inc. Operating earnings in 1977 of $21,904,000, or $22.54 per share, were moderately better than anticipated a year ago. Of these earnings, $1.43 per share resulted from substantial realized capital gains by blue-chip stamps which, to the extent of our proportional interest in that company, are included in our operating earnings figure. Capital gains or losses realized directly by Berkshire Hathaway Inc. or its insurance subsidiaries are not included in our calculation of operating earnings. While too much attention should not be paid to the figure for any single year, over the longer term the record regarding aggregate capital gains or losses obviously is of significance. Textile operations came in well below forecast, while the results of the Illinois National Bank as well as the operating earnings attributable to our equity interest in blue-chip stamps were about as anticipated. However, insurance operations, led again by the truly outstanding results of Phil Leachay's managerial group at National Indemnity Company, were even better than our optimistic expectations. Most companies define record earnings as a new high in earnings per share. Since businesses customarily add from year to year to their equity base, we find nothing particularly noteworthy in a management performance combining, say, a 10% increase in equity capital and a 5% increase in earnings per share. After all, even a totally dormant savings account will produce steadily rising interest earnings each year because of compounding. Except for special cases, for example, companies with unusual debt-equity ratios are those with important assets carried at unrealistic balance sheet values. We believe a more appropriate measure of managerial economic performance to be return on equity capital. In 1977, our operating earnings on beginning equity capital amounted to 19%, slightly better than last year and above both our own long-term average and that of American industry in aggregate. But, while our operating earnings per share were up 37% from the year before, our beginning capital was up 24%, making the gain in earnings per share considerably less impressive than it might appear at first glance. We expect difficulty in matching our 1977 rate of return during the forthcoming year. Beginning equity capital is up 23% from a year ago, and we expect the trend of insurance underwriting profit margins to turn down well before the end of the year.
Nevertheless, we expect a reasonably good year in our present estimate, subject to the usual caveats regarding the frailties of forecasts, is that operating earnings will improve somewhat on a per-share basis during 1978.
Textile operations. The textile business again had a very poor year in 1977. We have mistakenly predicted better results in each of the last 2 years. This may say something about our forecasting abilities, the nature of the textile industry, or both. Despite strenuous efforts, problems in marketing and manufacturing have persisted. Many difficulties experienced in the marketing area are due primarily to industry conditions, but some of the problems have been of our own making. A few shareholders have questioned the wisdom of remaining in the textile business, which, over the longer term, is unlikely to produce returns on capital comparable to those available in many other businesses.
Our reasons are several. 1. Our mills in both New Bedford and Manchester are among the largest employers in each town, utilizing a labor force of high average age possessing relatively non-transferable skills.
Our workers and unions have exhibited unusual understanding and effort in cooperating with management to achieve a cost structure and product mix which might allow us to maintain a viable operation. 2. Management also has been energetic and straightforward in its approach to our textile problems.
In particular, Ken Chase's efforts after the change in corporate control took place in 1965 generated capital from the textile division needed to finance the acquisition and expansion of our profitable insurance operation.
3. With hard work and some imagination regarding manufacturing and marketing configurations, it seems reasonable that at least modest profits in the textile division can be achieved in the future. Insurance underwriting. Our insurance operation continued to grow significantly in 1977. It was early in 1967 that we made our entry into this industry through the purchase of National Indemnity Company and National Fire and Marine Insurance Company, sister companies, for approximately $8.6 million. In that year their premium volume amounted to $22 million. In 1977 our aggregate insurance premium volume was $151 million. No additional shares of Berkshire Hathaway stock have been issued to achieve any of this growth. Rather, this almost 600% increase has been achieved through large gains in National Indemnity's traditional liability areas plus the starting of new companies, Cornhusker Casualty Company in 1970, Lakeland Fire and Casualty Company in 1971, Texas United Insurance Company in 1972, the Insurance Company of Iowa in 1973, and Kansas Fire and Casualty Company in late 1977. The purchase for cash of other insurance companies, Home and Automobile Insurance Company in 1971, Kirkling Reinsurance Corporation, now named Central Fire and Casualty Company, in 1976, and Cypress Insurance Company at year-end 1977. And finally through the marketing of additional products, most significantly reinsurance, within the National Indemnity Company corporate structure. In aggregate, the insurance business has worked out very well. But it hasn't been a one-way street. Some major mistakes have been made during the decade, both in products and personnel. We experienced significant problems from 1. A surety operation initiated in 1969, 2. The 1973 expansion of Home and Automobile's urban auto marketing into the Miami, Florida area, 3. A still unresolved aviation, fronting, arrangement, and 4. Our workers' compensation operation in California, which we believe retains an interesting potential upon completion of a reorganization now in progress. It is comforting to be in a business where some mistakes can be made and yet a quite satisfactory overall performance can be achieved.
In a sense, this is the opposite case from our textile business, where even very good management probably can average only modest results.
One of the lessons your management has learned, and, unfortunately, sometimes relearned, is the importance of being in businesses where tailwinds prevail rather than headwinds. In 1977, the winds in insurance underwriting were squarely behind us. Very large rate increases were effected throughout the industry in 1976 to offset the disastrous underwriting results of 1974 and 1975. But, because insurance policies typically are written for one-year periods, with pricing mistakes capable of correction only upon renewal, it was 1977 before the full impact was felt upon earnings of those earlier rate increases. The pendulum now is beginning to swing the other way. We estimate that costs involved in the insurance areas in which we operate rise at close to 1% per month. This is due to continuous monetary inflation affecting the cost of repairing humans and property, as well as social inflation, a broadening definition by society and juries of what is covered by insurance policies. Unless rates rise at a comparable 1% per month, underwriting profits must shrink.
Recently, the pace of rate increases has slowed dramatically, and it is our expectation that underwriting margins generally will be declining by the second half of the year. We must again give credit to Phil Leach, greatly assisted by Roland Miller in underwriting and Bill Lyons in claims, for an extraordinary underwriting achievement in National Indemnity's traditional auto and general liability business during 1977.
Large volume gains have been accompanied by excellent underwriting margins following contraction or withdrawal by many competitors in the wake of the 1974-75 crisis period. These conditions will reverse before long. In the meantime, National Indemnity's underwriting profitability has increased dramatically and, in addition, large sums have been made available for investment.
As markets loosen and rates become inadequate, we again will face the challenge of philosophically accepting reduced volume.
Unusual managerial discipline will be required, as it runs counter to normal institutional behavior to let the other fellow take away business, even at foolish prices. Our reinsurance department, managed by George Young, improved its underwriting performance during 1977.
Although the combined ratio, see definition on page 12, of 107.1 was unsatisfactory, its trend was downward throughout the year.
In addition, reinsurance generates unusually high funds for investment as a percentage of premium volume. At Home and Auto, John Seward continued to make progress on all fronts. John was a battlefield promotion several years ago when Home and Auto's underwriting was awash in red ink and the company faced possible extinction. Under his management, it currently is sound, profitable, and growing.
John Ringwald's home state operation now consists of 5 companies, with Kansas Fire and Casualty Company becoming operational late in 1977 under the direction of Floyd Taylor. The home state companies had net premium volume of $23 million, up from $5.5 million just 3 years ago. All 4 companies that operated throughout the year achieved combined ratios below 100, with Cornhusker Casualty Company, at 93.8, the leader. In addition to actively supervising the other 4 home state operations, John Ringwald manages the operations of Cornhusker, which has recorded combined ratios below 100 in 6 of its 7 full years of existence and, from a standing start in 1970, has grown to be one of the leading insurance companies operating in Nebraska utilizing the conventional independent agency system. Lakeland Fire and Casualty Company, managed by Jim Stadolka, was the winner of the Chairman's Cup in 1977 for achieving the lowest loss ratio among the home state companies. All in all, the home state operation continues to make excellent progress. The newest addition to our insurance group is Cypress Insurance Company of South Pasadena, California. This workers' compensation insurer was purchased for cash in the final days of 1977 and, therefore,
its approximate $12.5 million of volume for that year was not included in our results. Cyprus and National Indemnity's present California workers' compensation operation will not be combined, but will operate independently utilizing somewhat different marketing strategies. Milt Thornton, president of Cyprus since 1968, runs a first-class operation for policyholders, agents, employees and owners alike. We look forward to working with him. Insurance companies offer standardized policies which can be copied by anyone. Their only products are promises. It is not difficult to be licensed, and rates are an open book. There are no important advantages from trademarks, patents, location, corporate longevity, raw material sources, etc., and very little consumer differentiation to produce insulation from competition. It is commonplace, in corporate annual reports, to stress the difference that people make. Sometimes this is true and sometimes it isn't. But there is no question that the nature of the insurance business magnifies the effect which individual managers have on company performance. We are very fortunate to have the group of managers that are associated with us. Insurance investments during the past 2 years. Insurance investments at cost, excluding the investment in our affiliate, Blue Chip Stamps, have grown from $134.6 million to $252.8 million. Growth in insurance reserves, produced by our large gain in premium volume, plus retained earnings, have accounted for this increase in marketable securities. In turn, net investment income of the insurance group has improved from $8.4 million pre-tax in 1975 to $12.3 million pre-tax in 1977. In addition to this income from dividends and interest, we realized capital gains of $6.9 million before tax, about 1/4 from bonds and the balance from stocks. Our unrealized gain in stocks at year-end 1977 was approximately $74 million, but this figure, like any other figure of a single date, we had an unrealized loss of $17 million at the end of 1974, should not be taken too seriously. Most of our large stock positions are going to be held for many years, and the scorecard on our investment decisions will be provided by business results over that period, and not by prices on any given day. Just as it would be foolish to focus unduly on short-term prospects when acquiring an entire company, we think it equally unsound to become mesmerized by prospective near-term earnings or recent trends in earnings when purchasing small pieces of a company, i.e., marketable common stocks. A little digression illustrating this point may be interesting. Berkshire Fine Spinning Associates and Hathaway Manufacturing were merged in 1955 to form Berkshire Hathaway Inc. In 1948, on a pro forma combined basis, they had earnings after tax of almost $18 million and employed 10,000 people at a dozen large mills throughout New England. In the business world of that period, they were an economic powerhouse. For example, in that same year, earnings of IBM were $28 million, now $2.7 billion, Safeway Stores, $10 million, Minnesota Mining, $13 million, and Time, Inc., $9 million. But, in the decade following the 1955 merger, aggregate sales of $595 million produced an aggregate loss for Berkshire Hathaway of $10 million. By 1964, the operation had been reduced to 2 mills and net worth had shrunk to $22 million, from $53 million at the time of the merger. So much for single-year snapshots as adequate portrayals of a business.
Equity holdings of our insurance companies with a market value of over $5 million on December 31, 1977 were as follows. No of shares company cost, O omitted, market, O omitted, 220,000 Capital Cities Communications, Inc. $10,909, $13,228, $1,986,953 Government Employees Insurance Company Convertible Preferred $19,417, $33,033, $1,294,308 Government Employees Insurance Company Common Stock $4,116, $10,516, $592,650 Interpublic Group of Companies companies $4,531, $17,187, $324,580. Kaiser Aluminum and Chemical Corporation $11,218, $9,981, $1,305,800. Kaiser Industries, Inc.
$778, $6,039, $226,900. Knight Ridder Newspapers, Inc. $7,534, $8,736, $170,800. Ogilvy and Mather International, Inc. $2,762, $6,960, $934,300. The Washington Post Company Class B $10,628, $33,401. Total $71,893, $139,081. All other holdings $34,996, $41,992. Total equities $106,889, $181,073. We select our marketable equity securities in much the same way we would evaluate a business for acquisition in its entirety. We want the business to be 1. One that we can understand, 2. With favorable long-term prospects, 3. Operated by honest and competent people, and 4. Available at a very attractive price. We ordinarily make no attempt to buy equities for anticipated favorable stock price behavior in the short term. In fact, if their business experience continues to satisfy us, we welcome lower market prices of stocks we own as an opportunity to acquire even more of a good thing at a better price. Our experience has been that pro rata portions of truly outstanding businesses sometimes sell in the securities markets at very large discounts from the prices they would command in negotiated transactions involving entire companies. Consequently, bargains in business ownership, which simply are not available directly through corporate acquisition, can be obtained indirectly through stock ownership. When prices are appropriate, we are willing to take very large positions in selected companies, not with any intention of taking control and not foreseeing sell-out or merger, but with the expectation that excellent business results by corporations will translate over the long term into correspondingly excellent market value and dividend results for owners, minority as well as majority. Such investments initially may have negligible impact on our operating earnings. For example, we invested $10.9 million in Capital Cities Communications during 1977. Earnings attributable to the shares we purchased totaled about $1.3 million last year. But only the cash dividend, which currently provides $40,000 annually, is reflected in our operating earnings figure. Capital Cities possesses both extraordinary properties and extraordinary management. And these management skills extend equally to operations and employment of corporate capital. To purchase, directly, properties such as Capital Cities owns would cost in the area of twice our cost of purchase via the stock market, and direct ownership would offer no important advantages to us. While control would give us the opportunity, and the responsibility, to manage operations and corporate resources, we would not be able to provide management in either of those respects equal to that now in place. In effect, we can obtain a better management result through non-control than control.
This is an unorthodox view, but one we believe to be sound.
Banking in 1977, the Illinois National Bank continued to achieve a rate of earnings on assets about 3 times that of most large banks. As usual, this record was achieved while the bank paid maximum rates to savers and maintained an asset position combining low risk and exceptional liquidity. Gene Abig formed the bank in 1931 with $250,000. In its first full year of operation, earnings amounted to $8,782. Since that time, no new capital has been contributed to the bank. On the contrary, since our purchase in 1969, dividends of $20 million have been paid. Earnings in 1977 amounted to $3.6 million, more than achieved by many banks 2 or 3 times its size. Late last year Gene, now 80 and still running a banking operation without peer, asked that a successor be brought in. Accordingly, Peter Jeffrey, formerly President and Chief Executive Officer of American National Bank of Omaha, has joined the Illinois National Bank effective March 1 as President and Chief Executive Officer.
Gene continues in good health as chairman.
We expect a continued successful operation at Rockford's leading bank. Blue chip stamps. We again increased our equity interest in blue chip stamps, and owned approximately 36.5% at the end of 1977. Blue chip had a fine year, earning approximately $12.9 million from operations and, in addition, had realized securities gains of $4.1 million. Both Wesco Financial Corp., an 80% owned subsidiary of Blue Chip Stamps, managed by Louis Vincenti, and See's Candies, a 99% owned subsidiary, managed by Chuck Huggins, made good progress in 1977. Since See's was purchased by Blue Chip Stamps at the beginning of 1972, pre-tax operating earnings have grown from $4.2 million to $12.6 million with little additional capital investment. See's achieved this record while operating in an industry experiencing practically no unit growth. Shareholders of Berkshire Hathaway Inc. may obtain the annual report of Blue Chip Stamps by requesting it from Mr. Robert H. Bird, Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040. 1978 Letter Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Inc. First, a few words about accounting. The merger with Diversified Retailing Company, Inc. at year-end adds two new complications in the presentation of our financial results. After the merger, our ownership of Blue Chip Stamps increased to approximately 58% and, therefore, the accounts of that company must be fully consolidated in the balance sheet and statement of earnings presentation of Berkshire. In previous reports, our share of the net earnings only of Blue Chip had been included as a single item on Berkshire's statement of earnings, and there had been a similar one-line inclusion on our balance sheet of our share of their net assets. This full consolidation of sales, expenses, receivables, inventories, debt, etc., produces an aggregation of figures from many diverse businesses: textiles, insurance, candy, newspapers, trading stamps, with dramatically different economic characteristics. In some of these your ownership is 100%, but in those businesses which are owned by Blue Chip but fully consolidated, your ownership as a Berkshire shareholder is only 58%. Ownership by others of the balance of these businesses is accounted for by the large minority interest item on the liability side of the balance sheet. Such a grouping of balance sheet and earnings items, some wholly owned, some partly owned, tends to obscure economic reality more than illuminate it. In fact, it represents a form of presentation that we never prepare for internal use during the year and which is of no value to us in any management activities.
For that reason, throughout the report we provide much separate financial information and commentary on the various segments of the business to help you evaluate Berkshire's performance and prospects. Much of this segmented information is mandated by SEC disclosure rules and covered in Management's Discussion on pages 29 to 34.
And in this letter we try to present to you a view of our various operating entities from the same perspective that we view them managerially.
A second complication arising from the merger is that the 1977 figures shown in this report are different from the 1977 figures shown in the report we mailed to you last year.
Accounting convention requires that when two entities such as Diversified and Berkshire are merged, all financial data subsequently must be presented as if the companies had been merged at the time they were formed rather than just recently. So the enclosed financial statements, in effect, pretend that in 1977, and earlier years, the Diversified Berkshire merger already had taken place, even though the actual merger date was December 30, 1978. This shifting base makes comparative commentary confusing and, from time to time in our narrative report, we will talk of figures and performance for Berkshire shareholders as historically reported to you rather than as restated after the Diversified merger. With that preamble, it can be stated that, with or without restated figures, 1978 was a good year. Operating earnings, exclusive of capital gains, at 19.4% of beginning shareholders' investment were within a fraction of our 1972 record. While we believe it is improper to include capital gains or losses in evaluating the performance of a single year, They are an important component of the longer-term record.
Because of such gains, Berkshire's long-term growth in equity per share has been greater than would be indicated by compounding the returns from operating earnings that we have reported annually. For example, over the last 3 years, generally a bonanza period for the insurance industry, our largest profit producer, Berkshire's per share net worth virtually has doubled, thereby compounding at about 25% annually through a combination of good operating earnings and fairly substantial capital gains.
Neither this 25% equity gain from all sources nor the 19.4% equity gain from operating earnings in 1978 is sustainable.
The insurance cycle has turned downward in 1979, and it is almost certain that operating earnings measured by return on equity will fall this year. However, operating earnings measured in dollars are likely to increase on the much larger shareholders' equity now employed in the business.
In contrast to this cautious view about near-term return from operations, we are optimistic about prospects for long-term return from major equity investments held by our insurance companies. We make no attempt to predict how security markets will behave. Successfully forecasting short-term stock price movements is something we think neither we nor anyone else can do. In the longer run, however, we feel that many of our major equity holdings are going to be worth considerably more money than we paid, and that investment gains will add significantly to the operating returns of the insurance group.
Sources of earnings. To give you a better picture of just where Berkshire's earnings are produced, we show below a table which requires a little explanation. Berkshire owns close to 58% of Blue Chip, which, in addition to 100% ownership of several businesses, owns 80% of Wesco Financial Corporation. Thus, Berkshire's equity in Wesco's earnings is about 46%.
In aggregate, businesses that we control have about 7,000 full-time employees and generate revenues of over $500 million. The table shows the overall earnings of each major operating category on a pre-tax basis. Several of the businesses have low tax rates because of significant amounts of tax-exempt interest and dividend income, as well as the share of those earnings belonging to Berkshire both on a pre-tax and after-tax basis.
Significant capital gains or losses attributable to any of the businesses are not shown in the operating earnings figure, but are aggregated on the realized securities gain line at the bottom of the table.
Because of various accounting and tax intricacies, the figures in the table should not be treated as holy writ, but rather viewed as close approximations of the 1977 and 1978 earnings contributions of our constituent businesses. Earnings before income taxes, net earnings after tax, total Berkshire share O of $S1978, 1977, 1978, 1977, 1978, 1977 total. All entities $66,180, $57,089, $54,350, $42,234, $39,242, $30,393. Earnings from operations. Insurance Group. Underwriting $3,001, $5,802, $3,000, $5,802, $1,560, $3,017. Net investment income $19,705, $12,804, $19,691, $12,804, $16,400, $11,360. Berkshire Wambeck Textiles $2,916, $620, $2,916, $620, $1,342, $322. Associated Retail Stores, Inc. $2,757, $2,775, $2,757, $2,775, $1,176, $1,429. See's Candies $12,482, $12,840, $7,013, $6,598, $3,049, $2,974. Buffalo Evening News $2,913, $751, $1,637, $389, $738, $158. Blue Chip Stamps, Parent $2,133, $1,091, $1,198, $566, $1,382, $892. Illinois National Bank and Trust Company $4,822, $3,800, $4,710, $3,706, $4,262, $3,288. Wesco Financial Corporation. Parent $1,771, $2,006, $777, $813, $665, $419. Mutual Savings and Loan Association $10,556, $6,779, $4,638, $2,747, $3,042, $1,946. Interest on debt $5,566, $5,302, $4,546, $4,255, $2,349, $2,129. Other $720, $165, $438, $102, $261, $48. Total earnings from operations $52,384, $42,891, $40,955, $31,427, $30,052, $23,080. Realized securities gain $13,796, $14,198, $13,395, $10,807, $9,190, $7,313. Total earnings $66,180, $57,089, $54,350, $42,234, $39,242, $30,393. Blue Chip and Wesco are public companies with reporting requirements of their own. Later in this report we are reproducing the narrative reports of the principal executives of both companies, describing their 1978 operations. Some of the figures they utilize will not match to the penny the ones we use in this report, again because of accounting and tax complexities. But their comments should be helpful to you in understanding the underlying economic characteristics of these important partly owned businesses.
A copy of the full annual report of either company will be mailed to any shareholder of Berkshire upon request to Mr. Robert H. Bird for Blue Chips Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040, or to Mrs.
Betty Deckard for Wesco Financial Corporation, 315 East Colorado Boulevard, Pasadena, California, 91109.
Textiles earnings of $1.3 million in 1978, while much improved from 1977, still represent a low return on the $17 million of capital employed in this business.
Textile plant and equipment are on the books for a very small fraction of what it would cost to replace such equipment today.
And, despite the age of the equipment, much of it is functionally similar to new equipment being installed by the industry.
But despite this bargain cost of fixed assets, capital turnover is relatively low, reflecting required high investment levels in receivables and inventory compared to sales. Slow capital turnover, coupled with low profit margins on sales, inevitably produces inadequate returns on capital.
Obvious approaches to improved profit margins involve differentiation of product, lowered manufacturing costs through more efficient equipment or better utilization of people, redirection toward fabrics enjoying stronger market trends, etc.
Our management is diligent in pursuing such objectives. The problem, of course, is that our competitors are just as diligently doing the same thing. The textile industry illustrates in textbook style how producers of relatively undifferentiated goods in capital-intensive businesses must earn inadequate returns except under conditions of tight supply or real shortage. As long as excess productive capacity exists, prices tend to reflect direct operating costs rather than capital employed. Such a supply excess condition appears likely to prevail most of the time in the textile industry, and our expectations are for profits of relatively modest amounts in relation to capital. We hope we don't get into too many more businesses with such tough economic characteristics. But, as we have stated before, 1. our textile businesses are very important employers in their communities. 2. Management has been straightforward in reporting on problems and energetic in attacking them. 3. Labor has been cooperative and understanding in facing our common problems. And 4. The business should average modest cash returns relative to investment. As long as these conditions prevail, and we expect that they will, we intend to continue to support our textile business despite more attractive alternative uses for capital. Insurance underwriting. The number one contributor to Berkshire's overall excellent results in 1978 was the segment of National Indemnity Company's insurance operation run by Phil Lesh. On about $90 million of earned premiums, an underwriting profit of approximately $11 million was realized, a truly extraordinary achievement even against the background of excellent industry conditions. Under Phil's leadership, with outstanding assistance by Roland Miller in underwriting and Bill Lyons in claims, this segment of National Indemnity, including National Fire and Marine Insurance Company, which operates as a running mate, had one of its best years in a long history of performances which, in aggregate, far outshine those of the industry. Present successes reflect credit not only upon present managers, but equally upon the business talents of Jack Ringwalt, founder of National Indemnity, whose operating philosophy remains etched upon the company. Home and Automobile Insurance Company had its best year since John Seward stepped in and straightened things out in 1975. Its results are combined in this report with those of Phil Lesh's operation under the insurance category entitled Specialized Auto and General Liability. Workers' compensation was a mixed bag in 1978. In its first year as a subsidiary, Cypress Insurance Company, managed by Milt Thornton, turned in outstanding results. The workers' compensation line can cause large underwriting losses when rapid inflation interacts with changing social concepts, but Milt has a cautious and highly professional staff to cope with these problems. His performance in 1978 has reinforced our very good feelings about this purchase. Frank DiNardo came with us in the spring of 1978 to straighten out National Indemnity's California workers' compensation business which, up to that point, had been a disaster. Frank has the experience and intellect needed to correct the major problems of the Los Angeles office. Our volume in this department now is running only about 25% of what it was 18 months ago, and early indications are that Frank is making good progress.
George Young's reinsurance department continues to produce very large sums for investment relative to premium volume, and thus gives us reasonably satisfactory overall results.
However, underwriting results still are not what they should be and can be. It is very easy to fool yourself regarding underwriting results in reinsurance, particularly in casualty lines involving long delays in settlement, and we believe this situation prevails with many of our competitors. Unfortunately, self-delusion in company reserving almost always leads to inadequate industry rate levels. If major factors in the market don't know their true costs, the competitive fallout hits all, even those with adequate cost knowledge. George is quite willing to reduce volume significantly, if needed, to achieve satisfactory underwriting, and we have a great deal of confidence in the long-term soundness of this business under his direction. The home state operation was disappointing in 1978. Our unsatisfactory underwriting, even though partially explained by an unusual incidence of Midwestern storms, is particularly worrisome against the backdrop of very favorable industry results in the conventional lines written by our home state group. We have confidence in John Ringwalt's ability to correct this situation. The bright spot in the group was the performance of Kansas Fire and Casualty in its first full year of business. Under Floyd Taylor, this subsidiary got off to a truly remarkable start. Of course, it takes at least several years to evaluate underwriting results, but the early signs are encouraging and Floyd's operation achieved the best loss ratio among the home state companies in 1978. Although some segments were disappointing, overall our insurance operation had an excellent year. But of course we should expect a good year when the industry is flying high, as in 1978. It is a virtual certainty that in 1979 the combined ratio, see definition on page 31, for the industry will move up at least a few points, perhaps enough to throw the industry as a whole into an underwriting loss position.
For example, in the auto lines, by far the most important area for the industry and for us, CPI figures indicate rates overall were only 3% higher in January 1979 than a year ago.
But the items that make up loss costs, auto repair and medical care costs, were up over 9%. How different than year-end 1976 when rates had advanced over 22% in the preceding 12 months, but costs were up 8%. Margins will remain steady only if rates rise as fast as costs. This assuredly will not be the case in 1979, and conditions probably will worsen in 1980. Our present thinking is that our underwriting performance relative to the industry will improve somewhat in 1979, but every other insurance management probably views its relative prospects with similar optimism. Someone is going to be disappointed.
Even if we do improve relative to others, we may well have a higher combined ratio and lower underwriting profits in 1979 than we achieved last year.
We continue to look for ways to expand our insurance operation. But your reaction to this intent should not be unrestrained joy. Some of our expansion efforts, largely initiated by your chairman, have been lackluster, others have been expensive failures. We entered the business in 1967 through purchase of the segment which Phil Leach now manages, and it still remains, by a large margin, the best portion of our insurance business. It is not easy to buy a good insurance business, but our experience has been that it is easier to buy one than create one. However, we will continue to try both approaches, since the rewards for success in this field can be exceptional. Insurance investments. We confess considerable optimism regarding our insurance equity investments. Of course, our enthusiasm for stocks is not unconditional.
Under some circumstances, common stock investments by insurers make very little sense.
We get excited enough to commit a big percentage of insurance company net worth to equities only when we find 1. Businesses we can understand, 2. With favorable long-term prospects, 3. Operated by honest and competent people, and 4. Priced very attractively. We usually can identify a small number of potential investments meeting requirements, 1, 2, and 3. But 4 often prevents action.
For example, in 1971 our total common stock position at Berkshire's insurance subsidiaries amounted to only $10.7 million at cost, and $11.7 million at market.
There were equities of identifiably excellent companies available, but very few at interesting prices. An irresistible footnote. In 1971, pension fund managers invested a record 122% of net funds available in equities, at full prices they couldn't buy enough of them. In 1974, after the bottom had fallen out, they committed a then record low of 21% to stocks. The past few years have been a different story for us. At the end of 1975, our insurance subsidiaries held common equities with a market value exactly equal to cost of $39.3 million. At the end of 1978, this position had been increased to equities, including a convertible preferred, with a cost of $129.1 million and a market value of $216.5 million. During the intervening 3 years, we also had realized pre-tax gains from common equities of approximately $24.7 million.
Therefore, our overall unrealized and realized pre-tax gains in equities for the 3-year period came to approximately $112 million.
During this same interval, the Dow Jones Industrial Average declined from 852 to 805. It was a marvelous period for the value-oriented equity buyer.
We continue to find for our insurance portfolios small portions of really outstanding businesses that are available, through the auction pricing mechanism of security markets, at prices dramatically cheaper than the valuations inferior businesses command on negotiated sales. This program of acquisition of small fractions of businesses, common stocks, at bargain prices, for which little enthusiasm exists, contrasts sharply with general corporate acquisition activity, for which much enthusiasm exists.
It seems quite clear to us that either corporations are making very significant mistakes in purchasing entire businesses at prices prevailing in negotiated transactions and takeover bids, or that we eventually are going to make considerable sums of money buying small portions of such businesses at the greatly discounted valuations prevailing in the stock market.
A second footnote. In 1978, pension managers, a group that logically should maintain the longest of investment perspectives, put only 9% of net available funds into equities, breaking the record low figure set in 1974 and tied in 1977. We are not concerned with whether the market quickly revalues upward securities that we believe are selling at bargain prices.
In fact, we prefer just the opposite since, in most years, we expect to have funds available to be a net buyer of securities. And consistent attractive purchasing is likely to prove to be of more eventual benefit to us than any selling opportunities provided by a short-term run-up in stock prices to levels at which we are unwilling to continue buying. Our policy is to concentrate holdings. We try to avoid buying a little of this or that when we are only lukewarm about the business or its price. When we are convinced as to attractiveness, we believe in buying worthwhile amounts.
Equity holdings of our insurance companies with a market value of over $8 million on December 31, 1978 were as follows. No of shares company cost, O omitted, market, O omitted. 246,450 American Broadcasting Companies, Inc. $6,082, $8,626, $1,294,308 Government Employees Insurance Company Common Stock $4,116, $9,060, $1,986,953 Government Employees Insurance Company Preferred $19,417, $28,314, $592,650 Interpublic Group of Companies $4,531, $19,039, $1,066,934 Kaiser Aluminum and Chemical Corporation $18,085, $18,671, $453,800 Knight Ridder Newspapers, Inc. $7,534, $10,267, $953,750 Safeco Corporation $23,867, $26,467, $934,300 The Washington Post Company Class B $10,628, $43,445 Total $94,260, $163,889 All other holdings $39,506, $57,040 Total equities $133,766, $220,929 In some cases our indirect interest in earning power is becoming quite substantial.
For example, note our holdings of 953,750 shares of Safeco Corp. Safeco probably is the best-run large property and casualty insurance company in the United States.
Their underwriting abilities are simply superb, their loss reserving is conservative, and their investment policies make great sense.
Safeco is a much better insurance operation than our own, although we believe certain segments of ours are much better than average, is better than one we could develop in, similarly, is far better than any in which we might negotiate purchase of a controlling interest.
Yet our purchase of Safeco was made at substantially under book value.
We paid less than 100 cents on the dollar for the best company in the business, when far more than 100 cents on the dollar is being paid for mediocre companies in corporate transactions.
And there is no way to start a new operation, with necessarily uncertain prospects, at less than 100 cents on the dollar.
Of course, with a minor interest we do not have the right to direct or even influence management policies of Safeco. But why should we wish to do this? The record would indicate that they do a better job of managing their operations than we could do ourselves. While there may be less excitement and prestige in sitting back and letting others do the work, we think that is all one loses by accepting a passive participation in excellent management. Because, quite clearly, if one controlled a company run as well as Safeco, the proper policy also would be to sit back and let management do its job. Earnings attributable to the shares of Safeco owned by Berkshire at year-end amounted to $6.1 million during 1978, but only the dividends received, about 18% of earnings, are reflected in our operating earnings.
We believe the balance, although not reportable, to be just as real in terms of eventual benefit to us as the amount distributed. In fact, SAFECO's retained earnings, or those of other well-run companies if they have opportunities to employ additional capital advantageously, may well eventually have a value to shareholders greater than 100 cents on the dollar.
We are not at all unhappy when our wholly owned businesses retain all of their earnings if they can utilize internally those funds at attractive rates.
Why should we feel differently about retention of earnings by companies in which we hold small equity interests, but where the record indicates even better prospects for profitable employment of capital?
This proposition cuts the other way, of course, in industries with low capital requirements, or if management has a record of plowing capital into projects of low profitability. Then earnings should be paid out or used to repurchase shares, often by far the most attractive option for capital utilization. The aggregate level of such retained earnings attributable to our equity interests in fine companies is becoming quite substantial. It does not enter into our reported operating earnings, but we feel it well may have equal long-term significance to our shareholders. Our hope is that conditions continue to prevail in securities markets which allow our insurance companies to buy large amounts of underlying earning power for relatively modest outlays. At some point market conditions undoubtedly will again preclude such bargain buying, but, in the meantime, we will try to make the most of opportunities. Banking under Gene Abig and Pete Jeffrey, the Illinois National Bank and Trust Company in Rockford continues to establish new records. Last year's earnings amounted to approximately 2.1% of average assets, about 3 times the level averaged by major banks. In our opinion, this extraordinary level of earnings is being achieved while maintaining significantly less asset risk than prevails at most of the larger banks. We purchased the Illinois National Bank in March 1969. It was a first-class operation then, just as it had been ever since Gene Abig opened the doors in 1931. Since 1968, consumer time deposits have quadrupled, net income has tripled and trust department income has more than doubled, while costs have been closely controlled. Our experience has been that the manager of an already high-cost operation frequently is uncommonly resourceful in finding new ways to add to overhead, while the manager of a tightly run operation usually continues to find additional methods to curtail costs, even when his costs are already well below those of his competitors. No one has demonstrated this latter ability better than Gene Abig. We are required to divest our bank by December 31, 1980. The most likely approach is to spin it off to Berkshire shareholders sometime in the second half of 1980. Retailing upon merging with Diversified, we acquired 100% ownership of Associated Retail Stores, Inc., a chain of about 75 popular-priced women's apparel stores. Associated was launched in Chicago on March 7, 1931 with one store, $3,200, and 2 extraordinary partners, Ben Rosner and Leo Simon. After Mr. Simon's death, the business was offered to Diversified for cash in 1967. Ben was to continue running the business, and run it, he has. Associated's business has not grown, and it consistently has faced adverse demographic and retailing trends. But Ben's combination of merchandising, real estate and cost containment skills has produced an outstanding record of profitability, with returns on capital necessarily employed in the business often in the 20% after-tax area. Ben is now 75 and, like Gene Abig, 81, at Illinois National and Louis Vincenti, 73, at Wesco, continues daily to bring an almost passionately proprietary attitude to the business. This group of top managers must appear to an outsider to be an overreaction on our part to an OEO bulletin on age discrimination. While unorthodox, these relationships have been exceptionally rewarding, both financially and personally. It is a real pleasure to work with managers who enjoy coming to work each morning and, once there, instinctively and unerringly think like owners. We are associated with some of the very best. Warren E. Buffett, Chairman March 26, 1979 Letter Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Inc. Again, we must lead off with a few words about accounting. Since our last annual report, the accounting profession has decided that equity securities owned by insurance companies must be carried on the balance sheet at market value. We previously have carried such equity securities at the lower of aggregate cost or aggregate market value. Because we have large unrealized gains in our insurance equity holdings, the result of this new policy is to increase substantially both the 1978 and 1979 year-end net worth, even after the appropriate liability is established for taxes on capital gains that would be payable should equities be sold at such market valuations. As you know, Blue Chip Stamps, our 60% owned subsidiary, is fully consolidated in Berkshire Hathaway's financial statements. However, Blue Chip still is required to carry its equity investments at the lower of aggregate cost or aggregate market value, just as Berkshire Hathaway's insurance subsidiaries did prior to this year. Should the same equities be purchased at an identical price by an insurance subsidiary of Berkshire Hathaway and by Blue Chip Stamps, present accounting principles often would require that they end up carried on our consolidated balance sheet at two different values. That should keep you on your toes. Market values of Blue Chip Stamps equity holdings are given in footnote 3 on page 18. 1979 operating results. We continue to feel that the ratio of operating earnings, before securities gains or losses, to shareholders' equity with all securities valued at cost is the most appropriate way to measure any single year's operating performance. Measuring such results against shareholders' equity with securities valued at market could significantly distort the operating performance percentage because of wide year-to-year market value changes in the net worth figure that serves as the denominator. For example, a large decline in securities values could result in a very low market value net worth that, in turn, could cause mediocre operating earnings to look unrealistically good. Alternatively, the more successful that equity investments have been, the larger the net worth base becomes and the poorer the operating performance figure appears. Therefore, we will continue to report operating performance measured against beginning net worth, with securities valued at cost. On this basis, we had a reasonably good operating performance in 1979 but not quite as good as that of 1978, with operating earnings amounting to 18.6% of beginning net worth. Earnings per share, of course, increased somewhat, about 20%, but we regard this as an improper figure upon which to focus.
We had substantially more capital to work with in 1979 than in 1978. And our performance in utilizing that capital fell short of the earlier year, even though per-share earnings rose. Earnings per share will rise constantly on a dormant savings account or on a U.S. savings bond bearing a fixed rate of return simply because earnings, the stated interest rate, are continuously plowed back and added to the capital base.
Thus, even a stopped clock can look like a growth stock if the dividend payout ratio is low. The primary test of managerial economic performance is the achievement of a high earnings rate on equity capital employed, without undue leverage, accounting gimmickry, etc., and not the achievement of consistent gains in earnings per share. In our view, many businesses would be better understood by their shareholder owners, as well as the general public, if managements and financial analysts modify the primary emphasis they place upon earnings per share, and upon yearly changes in that figure. Long-term results in measuring long-term economic performance, in contrast to yearly performance, we believe it is appropriate to recognize fully any realized capital gains or losses as well as extraordinary items, and also to utilize financial statements presenting equity securities at market value. Such capital gains or losses, either realized or unrealized, are fully as important to shareholders over a period of years as earnings realized in a more routine manner through operations. It is just that their impact is often extremely capricious in the short run, a characteristic that makes them inappropriate as an indicator of single-year managerial performance. The book value per share of Berkshire Hathaway on September 30, 1964, the fiscal year end prior to the time that your present management assumed responsibility, was $19.46 per share. At year-end 1979, book value with equity holdings carried at market value was $335.85 per share. The gain in book value comes to 20.5% compounded annually. This figure, of course, is far higher than any average of our yearly operating earnings calculations, and reflects the importance of capital appreciation of insurance equity investments in determining the overall results for our shareholders.
It probably also is fair to say that the quoted book value in 1964 somewhat overstated the intrinsic value of the enterprise, since the assets owned at that time on either a going concern basis or liquidating value basis were not worth 100 cents on the dollar.
The liabilities were solid, however. We have achieved this result while utilizing a low amount of leverage, both financial leverage measured by debt to equity, and operating leverage measured by premium volume to capital funds of our insurance business, and also without significant issuance or repurchase of shares. Basically, we have worked with the capital with which we started. From our textile base we, or our Blue Chip and Wesco subsidiaries, have acquired total ownership of 13 businesses through negotiated purchases from private owners for cash, and have started 6 others.
It's worth a mention that those who have sold to us have, almost without exception, treated us with exceptional honor and fairness, both at the time of sale and subsequently. But before we drown in a sea of self-congratulation, a further, and crucial, observation must be made.
A few years ago, a business whose per-share net worth compounded at 20% annually would have guaranteed its owners a highly successful real investment return. Now such an outcome seems less certain. For the inflation rate, coupled with individual tax rates, will be the ultimate determinant as to whether our internal operating performance produces successful investment results, i.e., a reasonable gain in purchasing power from funds committed, for you as shareholders.
Just as the original 3% savings bond, a 5% passbook savings account or an 8% U.S. Treasury note have, in turn, been transformed by inflation into financial instruments that chew up, rather than enhance, purchasing power over their investment lives, a business earning 20% on capital can produce a negative real return for its owners under inflationary conditions not much more severe than presently prevail. If we should continue to achieve a 20% compounded gain, not an easy or certain result by any means, and this gain is translated into a corresponding increase in the market value of Berkshire Hathaway stock as it has been over the last 15 years, your after-tax purchasing power gain is likely to be very close to zero at a 14% inflation rate. Most of the remaining 6 percentage points will go for income tax any time you wish to convert your 20 percentage points of nominal annual gain into cash. That combination, the inflation rate plus the percentage of capital that must be paid by the owner to transfer into his own pocket the annual earnings achieved by the business, i.e., ordinary income tax on dividends and capital gains tax on retained earnings, can be thought of as an investor's misery index. When this index exceeds the rate of return earned on equity by the business, the investor's purchasing power, real capital, shrinks even though he consumes nothing at all. We have no corporate solution to this problem. High inflation rates will not help us earn higher rates of return on equity. One friendly but sharp-eyed commentator on Berkshire has pointed out that our book value at the end of 1964 would have bought about 1/2 ounce of gold and, 15 years later, after we have plowed back all earnings along with much blood, sweat and tears, the book value produced will buy about the same 1/2 ounce. A similar comparison could be drawn with Middle Eastern oil. The rub has been that government has been exceptionally able in printing money and creating promises, but is unable to print gold or create oil. We intend to continue to do as well as we can in managing the internal affairs of the business. But you should understand that external conditions affecting the stability of currency may very well be the most important factor in determining whether there are any real rewards from your investment in Berkshire Hathaway. Sources of earnings. We again present a table showing the sources of Berkshire's earnings. As explained last year, Berkshire owns about 60% of Blue Chip Stamps, which, in turn, owns 80% of Wesco Financial Corporation. The table shows both aggregate earnings of the various business entities, as well as Berkshire's share.
All of the significant capital gains or losses attributable to any of the business entities are aggregated in the realized securities gain figure at the bottom of the table, and are not included in operating earnings. Earnings before income taxes, net earnings after tax, total Berkshire share O of $S1979, 1978, 1979, 1978, 1979, 1978 total. All entities $68,632, $66,180, $54,350, $54,350, $39,242, $39,242 earnings from operations. Insurance Group. Underwriting $3,742, $3,001, $3,741, $3,000, $2,214, $1,560. Net investment income $24,224, $19,705, $24,216, $19,691, $20,106, $16,400. Berkshire Wambeck Textiles $1,723, $2,916, $1,723, $2,916, $848, $1,342. Associated Retail Stores Inc. $2,775, $2,757, $2,775, $2,757, $1,280, $1,176. See's Candies $12,785, $12,482, $7,598, $7,013, $3,448, $3,049. Buffalo Evening News $4,617, $2,913, $2,744, $1,637, $1,333, $738. Blue Chip Stamps. Parent $2,397, $2,133, $1,425, $1,198, $1,624, $1,382. Illinois National Bank and Trust Company $5,747, $4,822, $5,614, $4,710, $5,027, $4,262. Wesco Financial Corporation. Parent $2,413, $1,771, $1,098, $777, $937, $665. Mutual Savings and Loan Association $10,447, $10,556, $4,751, $4,638, $3,261, $3,042. Precision Steel $3,254 minus $1,480 to $723. Interest on debt $8,248, $5,566, $5,860, $4,546, $2,900, $2,349. Other $1,342, $720, $996, $438, $753. $261 total earnings from operations $57,984, $52,384, $46,813, $40,955, $35,988, $30,052. Realized securities gain $10,648, $13,796, $9,614, $13,395, $6,829, $9,190. Total earnings $68,632, $66,180, $56,427, $42,234, $42,817, $30,393. Blue Chip and Wesco are public companies with reporting requirements of their own. On pages 37 to 43 of this report, we have reproduced the narrative reports of the principal executives of both companies, in which they describe 1979 operations. Some of the numbers they mention in their reports are not precisely identical to those in the above table because of accounting and tax complexities. The Yanomamo Indians employ only 3 numbers: 1, 2, and more than 2. Maybe their time will come. However, the commentary in those reports should be helpful to you in understanding the underlying economic characteristics and future prospects of the important businesses that they manage.
A copy of the full annual report of either company will be mailed to any shareholder of Berkshire upon request to Mr. Robert H.
Bird for Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040, or to Mrs. Betty Deckard for Wesco Financial Corporation, 315 East Colorado Boulevard, Pasadena, California, 91109. Textiles and retailing. The relative significance of these 2 areas has diminished somewhat over the years as our insurance business has grown dramatically in size and earnings. Ben Rosner, at Associated Retail Stores, continues to pull rabbits out of the hat, big rabbits from a small hat. Year after year, he produces very large earnings relative to capital employed, realized in cash and not in increased receivables and inventories as in many other retail businesses, in a segment of the market with little growth and unexciting demographics. Ben is now 76 in, like our other up-and-comers, Gene Abig, 82, at Illinois National and Louis Vincenti, 74, at Wesco, regularly achieves more each year.
Our textile business also continues to produce some cash, but at a low rate compared to capital employed.
This is not a reflection on the managers, but rather on the industry in which they operate. In some businesses, a network TV station, for example, it is virtually impossible to avoid earning extraordinary returns on tangible capital employed in the business. And assets in such businesses sell at equally extraordinary prices, 1,000 cents or more on the dollar, a valuation reflecting the splendid, almost unavoidable, economic results obtainable. Despite a fancy price tag, the easy business may be the better route to go. We can speak from experience, having tried the other route. Your chairman made the decision a few years ago to purchase Wambeck Mills in Manchester, New Hampshire, thereby expanding our textile commitment. By any statistical test, the purchase price was an extraordinary bargain. We bought well below the working capital of the business and, in effect, got very substantial amounts of machinery and real estate for less than nothing. But the purchase was a mistake. While we labored mightily, new problems arose as fast as old problems were tamed. Both our operating and investment experience cause us to conclude that turnarounds seldom turn, and that the same energies and talent are much better employed in a good business purchased at a fair price than in a poor business purchased at a bargain price. Although a mistake, the Wambeck acquisition has not been a disaster. Certain portions of the operation are proving to be valuable additions to our decorator line, our strongest franchise, at New Bedford, and it's possible that we may be able to run profitably on a considerably reduced scale at Manchester. However, our original rationale did not prove out. Insurance underwriting. We predicted last year that the combined underwriting ratio, see definition on page 36, for the insurance industry would move up at least a few points, perhaps enough to throw the industry as a whole into an underwriting loss position. That is just about the way it worked out. The industry underwriting ratio rose in 1979 over 3 points, from roughly 97.4% to 100.7%. We also said that we thought our underwriting performance relative to the industry would improve somewhat in 1979 and, again, things worked out as expected. Our own underwriting ratio actually decreased from 98.2% to 97.1%. Our forecast for 1980 is similar in one respect. Again, we feel that the industry's performance will worsen by at least another few points. However, this year we have no reason to think that our performance relative to the industry will further improve. Don't worry. We won't hold back to try to validate that forecast. Really extraordinary results were turned in by the portion of National Indemnity Company's insurance operation run by Phil Leach. Aided by Roland Miller in underwriting and Bill Lyons in claims, This section of the business produced an underwriting profit of $8.4 million on about $82 million of earned premiums. Only a very few companies in the entire industry produced a result comparable to this. You will notice that earned premiums in this segment were down somewhat from those of 1978.
We hear a great many insurance managers talk about being willing to reduce volume in order to underwrite profitably, but we find that very few actually do so.
Phil Leach is an exception. If business makes sense, he writes it. If it doesn't, he rejects it.
It is our policy not to lay off people because of the large fluctuations in workload produced by such voluntary volume changes.
We would rather have some slack in the organization from time to time than keep everyone terribly busy writing business on which we are going to lose money. Jack Ringwald, the founder of National Indemnity Company, instilled this underwriting discipline at the inception of the company, and Phil Leach never has wavered in maintaining it.
We believe such strong-mindedness is as rare as it is sound, and absolutely essential to the running of a first-class casualty insurance operation.
John Seward continues to make solid progress at Home and Automobile Insurance Company, in large part by significantly expanding the marketing scope of that company in general liability lines.
These lines can be dynamite, but the record to date is excellent and, in John McGowan and Paul Springman, we have two cautious liability managers extending our capabilities.
Our reinsurance division, led by George Young, continues to give us reasonably satisfactory overall results after allowing for investment income, but underwriting performance remains unsatisfactory. We think the reinsurance business is a very tough business that is likely to get much tougher.
In fact, the influx of capital into the business and the resulting softer price levels for continually increasing exposures may well produce disastrous results for many entrants, of which they may be blissfully unaware until they are in over their heads. Much reinsurance business involves an exceptionally long tail, a characteristic that allows catastrophic current loss experience to fester undetected for many years. It will be hard for us to be a whole lot smarter than the crowd, and thus our reinsurance activity may decline substantially during the projected prolonged period of extraordinary competition.
The home state operation was disappointing in 1979.
Excellent results again were turned in by George Billings at Texas United Insurance Company, winner of the annual award for the low loss ratio among home state companies, and Floyd Taylor at Kansas Fire and Casualty Company.
But several of the other operations, particularly Cornhusker Casualty Company, our first and largest home state operation and historically a winner, had poor underwriting results which were accentuated by data processing, administrative and personnel problems. We have made some major mistakes in reorganizing our data processing activities, and those mistakes will not be cured immediately or without cost. However, John Ringwald has thrown himself into the task of getting things straightened out, and we have confidence that he, aided by several strong people who recently have been brought aboard, will succeed. Our performance in workers' compensation was far, far better than we had any right to expect at the beginning of 1979. We had a very favorable climate in California for the achievement of good results, but, beyond this, Milt Thornton at Cypress Insurance Company and Frank DiNardo at National Indemnity's California Workers' Compensation Operation both performed in a simply outstanding manner. We have admitted, and with good reason, some mistakes on the acquisition front, but the Cypress purchase has turned out to be an absolute gem. Milt Thornton, like Phil Leach, follows the policy of sticking with business that he understands and wants, without giving consideration to the impact on volume. As a result, he has an outstanding book of business and an exceptionally well-functioning group of employees. Frank DiNardo has straightened out the mess he inherited in Los Angeles in a manner far beyond our expectations, producing savings measured in 7 figures. He now can begin to build on a sound base. At year-end, we entered the specialized area of surety reinsurance under the management of Chet Noble. At least initially, this operation will be relatively small since our policy will be to seek client companies who appreciate the need for a long-term partnership relationship with their reinsurers. We are pleased by the quality of the insurers we have attracted, and hope to add several more of the best primary writers as our financial strength and stability become better known in the surety field. The conventional wisdom is that insurance underwriting overall will be poor in 1980, but that rates will start to firm in a year or so, leading to a turn in the cycle sometime in 1981. We disagree with this view. Present interest rates encourage the obtaining of business at underwriting loss levels formerly regarded as totally unacceptable.
Managers decry the folly of underwriting at a loss to obtain investment income, but we believe that many will. Thus, we expect that competition will create a new threshold of tolerance for underwriting losses, and that combined ratios will average higher in the future than in the past.
To some extent, the day of reckoning has been postponed because of marked reduction in the frequency of auto accidents, probably brought on in major part by changes in driving habits induced by higher gas prices.
In our opinion, if the habits hadn't changed, auto insurance rates would have been very little higher and underwriting results would have been much worse.
This dosage of serendipity won't last indefinitely. Our forecast is for an average combined ratio for the industry in the 105 area over the next 5 years.
While we have a high degree of confidence that certain of our operations will do considerably better than average, it will be a challenge to us to operate below the industry figure. You can get a lot of surprises in insurance.
Nevertheless, we believe that insurance can be a very good business. It tends to magnify, to an unusual degree, human managerial talent, or the lack of it. We have a number of managers whose talent is both proven and growing. And, in addition, we have a very large and direct interest in 2 truly outstanding management groups through our investments in Safeco and Geico. Thus, we expect to do well in insurance over a period of years. However, the business has the potential for really terrible results in a single specific year. If accident frequency should turn around quickly in the auto field, we, along with others, are likely to experience such a year. Insurance investments in recent years. We have written at length in this section about our insurance equity investments. In 1979 they continued to perform well, largely because the underlying companies in which we have invested, in practically all cases, turned in outstanding performances. Retained earnings applicable to our insurance equity investments, not reported in our financial statements, continue to mount annually and, in aggregate, now come to a very substantial number. We have faith that the managements of these companies will utilize those retained earnings effectively and will translate a dollar retained by them into a dollar or more of subsequent market value for us. In part, our unrealized gains reflect this process. Below we show the equity investments which had a year-end market value of over $5 million. No of shares company cost. O omitted. Market. O omitted. 289,700 affiliated publications, Inc. $2,821, $8,800, $112,545 Amarada Hess $2,861, $5,487, $246,450 American Broadcasting Companies, Inc. $6,082, $9,673, $5,730,114 Geico Corp. Common stock, $28,288, $68,045, $328,700 General Foods, Inc. $11,437, $11,053, $1,007,500 Handy and Harmon $21,825, $38,537, $711,180 Interpublic Group of Companies $4,531, $23,736, $1,211,834 Kaiser Aluminum and Chemical Corporation $20,629, $23,328, $282,500 Media General, Inc. $4,545, $7,345, $391,400 Ogilvy and Mather International $3,709, $7,828, $953,750 Safeco Corporation $23,867, $35,527, $1,868,000 The Washington Post Company Class B $10,628, $39,241 $71,771,900 F. W. Woolworth Company $15,515 $19,394 total $156,738 $297,994 all other holdings $28,675 $38,686 total equities $185,413 $336,680 We currently believe that equity markets in 1980 are likely to evolve in a manner that will result in an underperformance by our portfolio for the first time in recent years. We very much like the companies in which we have major investments, and plan no changes to try to attune ourselves to the markets of a specific year. Since we have covered our philosophy regarding equities extensively in recent annual reports, a more extended discussion of bond investments may be appropriate for this one, particularly in light of what has happened since year-end. An extraordinary amount of money has been lost by the insurance industry in the bond area, notwithstanding the accounting convention that allows insurance companies to carry their bond investments at amortized cost, regardless of impaired market value. Actually, that very accounting convention may have contributed in a major way to the losses. Had management been forced to recognize market values, its attention might have been focused much earlier on the dangers of a very long-term bond contract. Ironically, many insurance companies have decided that a one-year auto policy is inappropriate during a time of inflation, and 6-month policies have been brought in as replacements.
How, say many of the insurance managers, can we be expected to look forward 12 months and estimate such imponderables as hospital costs, auto parts prices, etc.? But, having decided that 1 year is too long a period for which to set a fixed price for insurance in an inflationary world, they then have turned around, taken the proceeds from the sale of that 6-month policy, and sold the money at a fixed price for 30 or 40 years.
The very long-term bond contract has been the last major fixed-price contract of extended duration still regularly initiated in an inflation-ridden world.
The buyer of money to be used between 1980 and 2020 has been able to obtain a firm price now for each year of its use, while the buyer of auto insurance, medical services, newsprint, office space, or just about any other product or service, would be greeted with laughter if he were to request a firm price now to apply through 1985.
For in virtually all other areas of commerce, parties to long-term contracts now either index prices in some manner, or insist on the right to review the situation every year or so. A cultural lag has prevailed in the bond area.
The buyers, borrowers, and middlemen, underwriters, of money hardly could be expected to raise the question of whether it all made sense, and the sellers, lenders, slept through an economic and contractual revolution. For the last few years, our insurance companies have not been a net purchaser of any straight long-term bonds, those without conversion rights or other attributes offering profit possibilities.
There have been some purchases in the straight bond area, of course, but they have been offset by sales or maturities. Even prior to this period, we never would buy 30 or 40-year bonds. Instead, we tried to concentrate in the straight bond area on shorter issues with sinking funds and on issues that seemed relatively undervalued because of bond market inefficiencies. However, the mild degree of caution that we exercised was an improper response to the world unfolding about us. You do not adequately protect yourself by being half awake while others are sleeping.
It was a mistake to buy 15-year bonds, and yet we did. We made an even more serious mistake in not selling them, at losses, if necessary, when our present views began to crystallize.
Naturally, those views are much clearer and definite in retrospect. It would be fair for you to ask why we weren't writing about this subject last year. Of course, we must hold significant amounts of bonds or other fixed dollar obligations in conjunction with our insurance operations. In the last several years, our net fixed dollar commitments have been limited to the purchase of convertible bonds. We believe that the conversion options obtained, in effect, give that portion of the bond portfolio a far shorter average life than implied by the maturity terms of the issues, i.e., at an appropriate time of our choosing, we can terminate the bond contract by conversion into stock.
This bond policy has given us significantly lower unrealized losses than those experienced by the great majority of property and casualty insurance companies.
We also have been helped by our strong preference for equities in recent years that has kept our overall bond segment relatively low. Nevertheless, we are taking our lumps in bonds and feel that, in a sense, our mistakes should be viewed less charitably than the mistakes of those who went about their business unmindful of the developing problems. Harking back to our textile experience, we should have realized the futility of trying to be very clever, via sinking funds and other special type issues, in an area where the tide was running heavily against us. We have severe doubts as to whether a very long-term fixed interest bond, denominated in dollars, remains an appropriate business contract in a world where the value of dollars seems almost certain to shrink by the day.
Those dollars, as well as paper creations of other governments, simply may have too many structural weaknesses to appropriately serve as a unit of long-term commercial reference.
If so, really long bonds may turn out to be obsolete instruments, and insurers who have bought those maturities of 2010 or 2020 could have major and continuing problems on their hands. We, likewise, will be unhappy with our 15-year bonds and will annually pay a price in terms of earning power that reflects that mistake. Some of our convertible bonds appear exceptionally attractive to us, and have the same sort of earnings retention factor, applicable to the stock into which they may be converted, that prevails in our conventional equity portfolio. We expect to make money in these bonds, we already have, in a few cases, and have hopes that our profits in this area may offset losses in straight bonds. And, of course, there is the possibility that our present analysis is much too negative.
The chances for very low rates of inflation are not nil.
Inflation is man-made, perhaps it can be man-mastered. The threat which alarms us may also alarm legislators and other powerful groups, prompting some appropriate response. Furthermore, present interest rates incorporate much higher inflation projections than those of a year or two ago. Such rates may prove adequate or more than adequate to protect bond buyers. We even may miss large profits from a major rebound in bond prices. However, our unwillingness to fix a price now for a pound of See's candy or a yard of Berkshire cloth to be delivered in 2010 or 2020 makes us equally unwilling to buy bonds which set a price on money now for use in those years. Overall, we opt for Polonius, slightly restated. Neither a short-term borrower nor a long-term lender be. Banking this will be the last year that we can report on the Illinois National Bank and Trust Company as a subsidiary of Berkshire Hathaway. Therefore, it is particularly pleasant to report that, under Gene Abbig's and Pete Jeffries' management, the bank broke all previous records and earned approximately 2.3% on average assets last year, a level again over 3 times that achieved by the average major bank, and more than double that of banks regarded as outstanding. The record is simply extraordinary, and the shareholders of Berkshire Hathaway owe a standing ovation to Gene Abbig for the performance this year and every year since our purchase in 1969. As you know, the Bank Holding Company Act of 1969 requires that we divest the bank by December 31, 1980. For some years we have expected to comply by effecting a spin-off during 1980. However, the Federal Reserve Board has taken the firm position that if the bank is spun off, no officer or director of Berkshire Hathaway can be an officer or director of the spun-off bank or bank holding company, even in a case such as ours in which one individual would own over 40% of both companies. Under these conditions, we are investigating the possible sale of between 80% and 100% of the stock of the bank. We will be most choosy about any purchaser, and our selection will not be based solely on price.
The bank and its management have treated us exceptionally well, and, if we have to sell, we want to be sure that they are treated equally as well. A spin-off still is a possibility if a fair price along with a proper purchaser cannot be obtained by early fall.
However, you should be aware that we do not expect to be able to fully, or even in very large part, replace the earning power represented by the bank from the proceeds of the sale of the bank.
You simply can't buy high-quality businesses at the sort of price, earnings multiple likely to prevail on our bank sale.
Financial reporting during 1979, NASDAQ trading was initiated in the stock of Berkshire Hathaway. This means that the stock now is quoted on the over-the-counter page of the Wall Street Journal under additional OTC quotes. Prior to such listing, the Wall Street Journal and the Dow Jones News Ticker would not report our earnings, even though such earnings were 100 or more times the level of some companies whose reports they regularly picked up.
Now, however, the Dow Jones News Ticker reports our quarterly earnings promptly after we release them and, in addition, both the ticker and the Wall Street Journal report our annual earnings.
This solves a dissemination problem that had bothered us. In some ways, our shareholder group is a rather unusual one, and this affects our manner of reporting to you. For example, at the end of each year about 98% of the shares outstanding are held by people who also were shareholders at the beginning of the year. Therefore, in our annual report we build upon what we have told you in previous years instead of restating a lot of material. You get more useful information this way, and we don't get bored.
Furthermore, perhaps 90% of our shares are owned by investors for whom Berkshire is their largest security holding, very often far and away the largest.
Many of these owners are willing to spend a significant amount of time with the annual report, and we attempt to provide them with the same information we would find useful if the roles were reversed. In contrast, we include no narrative with our quarterly reports. Our owners and managers both have very long time horizons in regard to this business, and it is difficult to say anything new or meaningful each quarter about events of long-term significance. But when you do receive a communication from us, it will come from the fellow you are paying to run the business. Your chairman has a firm belief that owners are entitled to hear directly from the CEO as to what is going on and how he evaluates the business, currently and prospectively. You would demand that in a private company, you should expect no less in a public company. A once-a-year report of stewardship should not be turned over to a staff specialist or public relations consultant who is unlikely to be in a position to talk frankly on a manager-to-owner basis.
We feel that you, as owners, are entitled to the same sort of reporting by your manager as we feel is owed to us at Berkshire Hathaway by managers of our business units. Obviously, the degree of detail must be different, particularly where information would be useful to a business competitor or the like.
But the general scope, balance, and level of candor should be similar. We don't expect a public relations document when our operating managers tell us what is going on, and we don't feel you should receive such a document.
In large part, companies obtain the shareholder constituency that they seek and deserve.
If they focus their thinking and communications on short-term results or short-term stock market consequences, they will, in large part, attract shareholders who focus on the same factors. And if they are cynical in their treatment of investors, eventually that cynicism is highly likely to be returned by the investment community. Phil Fisher, a respected investor and author, once likened the policies of the corporation in attracting shareholders to those of a restaurant attracting potential customers.
A restaurant could seek a given clientele, patrons of fast foods, elegant dining, oriental food, etc.,
and eventually obtain an appropriate group of devotees. If the job were expertly done, that clientele, pleased with the service, menu, and price level offered, would return consistently. But the restaurant could not change its character constantly and end up with a happy and stable clientele. If the business vacillated between French cuisine and takeout chicken, the result would be a revolving door of confused and dissatisfied customers. So it is with corporations and the shareholder constituency they seek. You can't be all things to all men, simultaneously seeking different owners whose primary interests run from high current yield to long-term capital growth to stock market pyrotechnics, etc. The reasoning of managements that seek large trading activity in their shares puzzles us. In effect, such managements are saying that they want a good many of the existing clientele continually to desert them in favor of new ones, because you can't add lots of new owners, with new expectations, without losing lots of former owners. We much prefer owners who like our service and menu and who return year after year. It would be hard to find a better group to sit in the Berkshire Hathaway shareholder seats than those already occupying them. So we hope to continue to have a very low turnover among our owners, reflecting a constituency that understands our operation, approves of our policies, and shares our expectations. And we hope to deliver on those expectations. prospects. Last year we said that we expected operating earnings in dollars to improve but return on equity to decrease. This turned out to be correct. Our forecast for 1980 is the same. If we are wrong, it will be on the downside. In other words, we are virtually certain that our operating earnings expressed as a percentage of the new equity base of approximately $236 million, valuing securities at cost, will decline from the 18.6% attained in 1979. There is also a fair chance that operating earnings in aggregate dollars will fall short of 1979. The outcome depends partly upon the date of disposition of the bank, partly upon the degree of slippage in insurance underwriting profitability, and partly upon the severity of earnings problems in the savings and loan industry. We continue to feel very good about our insurance equity investments. Over a period of years, we expect to develop very large and growing amounts of underlying earning power attributable to our fractional ownership of these companies. In most cases, they are splendid businesses, splendidly managed, purchased at highly attractive prices. Your company is run on the principle of centralization of financial decisions at the top, the very top, it might be added, and rather extreme delegation of operating authority to a number of key managers at the individual company or business unit level. We could just field a basketball team with our corporate headquarters group, which utilizes only about 1,500 square feet of space.
This approach produces an occasional major mistake that might have been eliminated or minimized through closer operating controls. But it also eliminates large layers of costs and dramatically speeds decision-making.
Because everyone has a great deal to do, a very great deal gets done. Most important of all, it enables us to attract and retain some extraordinarily talented individuals, people who simply can't be hired in the normal course of events, who find working for Berkshire to be almost identical to running their own show. We have placed much trust in them, and their achievements have far exceeded that trust. Warren E. Buffett, Chairman, March 3, 1980. 1980 Letter Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Inc. Operating earnings improved to $41.9 million in 1980 from $36 million in 1979, but return on beginning equity capital, with securities valued at cost, fell to 17.8% from 18.6%. We believe the latter yardstick to be the most appropriate measure of single-year managerial economic performance. Informed use of that yardstick, however, requires an understanding of many factors, including accounting policies, historical carrying values of assets, financial leverage, and industry conditions. In your evaluation of our economic performance, we suggest that two factors should receive your special attention, one of a positive nature peculiar, to a large extent, to our own operation, and one of a negative nature applicable to corporate performance generally. Let's look at the bright side first. Non-controlled ownership earnings. When one company owns part of another company, appropriate accounting procedures pertaining to that ownership interest must be selected from one of three major categories. The percentage of voting stock that is owned, in large part, determines which category of accounting principles should be utilized. Generally accepted accounting principles require, subject to exceptions, naturally, as with our former bank subsidiary, full consolidation of sales, expenses, taxes, and earnings of business holdings more than 50% owned. Blue chip stamps, 60% owned by Berkshire Hathaway Inc., falls into this category. Therefore, all blue chip income and expense items are included in full in Berkshire's consolidated statement of earnings, with the 40% ownership interest of others in blue chip's net earnings reflected in the statement as a deduction for minority interest. Full inclusion of underlying earnings from another class of holdings, companies owned 20% to 50%, usually called investees, also normally occurs. Earnings from such companies, for example, Wesco Financial, controlled by Berkshire but only 48% owned, are included via a one-line entry in the owner's statement of earnings. Unlike the over 50% category, all items of revenue and expense are omitted. Just the proportional share of net income is included. Thus, if Corporation A owns 1/3 of Corporation B, 1/3 of B's earnings, whether or not distributed by B, will end up in A's earnings. There are some modifications, both in this and the over 50% category, for intercorporate taxes and purchase price adjustments, the explanation of which we will save for a later day. We know you can hardly wait. Finally come holdings representing less than 20% ownership of another corporation's voting securities. In these cases, accounting rules dictate that the owning companies include in their earnings only dividends received from such holdings. Undistributed earnings are ignored. Thus, should we own 10% of Corporation X with earnings of $10 million in 1980, we would report in our earnings, ignoring relatively minor taxes on intercorporate dividends, either a $1 million if X declared the full $10 million in dividends, b. $500,000 if X paid out 50%, or $5 million, in dividends, or c. 0 if X reinvested all earnings. We impose this short, and oversimplified, course in accounting upon you because Berkshire's concentration of resources in the insurance field produces a corresponding concentration of its assets in companies in that third, less than 20% owned, category. Many of these companies pay out relatively small proportions of their earnings in dividends. This means that only a small proportion of their current earning power is recorded in our own current operating earnings. But, while our reported operating earnings reflect only the dividends received from such companies, our economic well-being is determined by their earnings, not their dividends. Our holdings in this third category of companies have increased dramatically in recent years as our insurance business has prospered and as securities markets have presented particularly attractive opportunities in the common stock area. The large increase in such holdings, plus the growth of earnings experienced by those partially owned companies, has produced an unusual result. The part of our earnings that these companies retained last year, the part not paid to us in dividends, exceeded the total reported annual operating earnings of Berkshire Hathaway. Thus, conventional accounting only allows less than half of our earnings, iceberg, to appear above the surface, in plain view. Within the corporate world, such a result is quite rare. In our case, it is likely to be recurring. Our own analysis of earnings reality differs somewhat from generally accepted accounting principles, particularly when those principles must be applied in a world of high and uncertain rates of inflation. But it's much easier to criticize than to improve such accounting rules. The inherent problems are monumental. We have owned 100% of businesses whose reported earnings were not worth close to 100 cents on the dollar to us, even though, in an accounting sense, we totally controlled their disposition. The control was theoretical. Unless we reinvested all earnings, massive deterioration in the value of assets already in place would occur. But those reinvested earnings had no prospect of earning anything close to a market return on capital. We have also owned small fractions of businesses with extraordinary reinvestment possibilities whose retained earnings had an economic value to us far in excess of 100 cents on the dollar. The value to Berkshire Hathaway of retained earnings is not determined by whether we own 100%, 50%, 20% or 1% of the businesses in which they reside. Rather, the value of those retained earnings is determined by the use to which they are put and the subsequent level of earnings produced by that usage. This is true whether we determine the usage, or whether managers we did not hire, but did elect to join, determine that usage. It's the act that counts, not the actors. And the value is in no way affected by the inclusion or non-inclusion of those retained earnings in our own reported operating earnings. If a tree grows in a forest partially owned by us, but we don't record the growth in our financial statements, we still own part of the tree. Our view, we warn you, is non-conventional. But we would rather have earnings for which we did not get accounting credit put to good use in a 10% owned company by a management we did not personally hire, than have earnings for which we did get credit put into projects of more dubious potential by another management, even if we are that management. We can't resist pausing here for a short commercial. One usage of retained earnings we often greet with special enthusiasm when practiced by companies in which we have an investment interest is repurchase of their own shares. The reasoning is simple. If a fine business is selling in the marketplace for far less than intrinsic value, What more certain or more profitable utilization of capital can there be than significant enlargement of the interests of all owners at that bargain price? The competitive nature of corporate acquisition activity almost guarantees the payment of a full, frequently more than full price when a company buys the entire ownership of another enterprise. But the auction nature of security markets often allows finely run companies the opportunity to purchase portions of their own businesses at a price under 50% of that needed to acquire the same earning power through the negotiated acquisition of another enterprise. Long-term corporate results. As we have noted, we evaluate single-year corporate performance by comparing operating earnings to shareholders' equity with securities valued at cost. Our long-term yardstick of performance, however, includes all capital gains or losses, realized or unrealized. We continue to achieve a long-term return on equity that considerably exceeds the average of our yearly returns. The major factor causing this pleasant result is a simple one. The retained earnings of those non-controlled holdings we discussed earlier have been translated into gains in market value. Of course, this translation of retained earnings into market price appreciation is highly uneven. It goes in reverse some years, unpredictable as to timing, and unlikely to materialize on a precise dollar-for-dollar basis. And a silly purchase price for a block of stock in a corporation can negate the effects of a decade of earnings retention by that corporation. But when purchase prices are sensible, some long-term market recognition of the accumulation of retained earnings almost certainly will occur. Periodically, you even will receive some frosting on the cake, with market appreciation far exceeding post-purchase retained earnings. In the 16 years since present management assumed responsibility for Berkshire, book value per share with insurance-held equities valued at market has increased from $19.46 to $400.80, or 20.5% compounded annually. You've done better. The value of the mineral content in the human body compounded at 22% annually during the past decade. It is encouraging, moreover, to realize that our record was achieved despite many mistakes. The list is too painful and lengthy to detail here, but it clearly shows that a reasonably competitive corporate batting average can be achieved in spite of a lot of managerial strikeouts. Our insurance companies will continue to make large investments in well-run, favorably situated, non-controlled companies that very often will pay out in dividends only small proportions of their earnings. Following this policy, we would expect our long-term returns to continue to exceed the returns derived annually from reported operating earnings. Our confidence in this belief can easily be quantified. If we were to sell the equities that we hold and replace them with long-term tax-free bonds, our reported operating earnings would rise immediately by over $30 million annually. Such a shift tempts us not at all. So much for the good news. Results for owners. Unfortunately, earnings reported in corporate financial statements are no longer the dominant variable that determines whether there are any real earnings for you, the owner. For only gains in purchasing power represent real earnings on investment. If you, a, forego 10 hamburgers to purchase an investment, b, receive dividends which, after tax, buy 2 hamburgers, and c, receive, upon sale of your holdings, after tax proceeds that will buy 8 hamburgers, then, d, you have had no real income from your investment, no matter how much it appreciated in dollars. You may feel richer, but you won't eat richer. High rates of inflation create a tax on capital that makes much corporate investment unwise, at least if measured by the criterion of a positive real investment return to owners. This hurdle rate, the return on equity that must be achieved by a corporation in order to produce any real return for its individual owners, has increased dramatically in recent years. The average tax-paying investor is now running up a down escalator whose pace has accelerated to the point where his upward progress is nil. For example, in a world of 12% inflation, a business earning 20% on equity, which very few manage consistently to do, and distributing it all to individuals in the 50% bracket is chewing up their real capital, not enhancing it. Half of the 20% will go for income tax. The remaining 10% leaves the owners of the business with only 98% of the purchasing power they possessed at the start of the year, even though they have not spent a penny of their earnings. The investors in this bracket would actually be better off with a combination of stable prices and corporate earnings on equity capital of only a few %. Explicit income taxes alone, unaccompanied by any implicit inflation tax, never can turn a positive corporate return into a negative owner return. Even if there were 90% personal income tax rates on both dividends and capital gains, some real income would be left for the owner at a zero inflation rate. But the inflation tax is not limited by reported income. Inflation rates not far from those recently experienced can turn the level of positive returns achieved by a majority of corporations into negative returns for all owners, including those not required to pay explicit taxes. For example, if inflation reached 16%, owners of the 60% plus of corporate America earning less than this rate of return would be realizing a negative real return, even if income taxes on dividends and capital gains were eliminated. Of course, the two forms of taxation coexist and interact since explicit taxes are levied on nominal, not real, income. Thus, you pay income taxes on what would be deficits if returns to stockholders were measured in constant dollars. At present inflation rates,